And last but not least, we're going to talk about the statement of cash flows. Corporate investors and potential investors seek information about a company's financial position, the results of operations, and their cash flows. This chapter describes the significance of the statement of cash flows and all aspects of its preparation. There are numerous examples included which will help you learn and understand how this statement is prepared and presented. After studying this chapter, you should be able to describe the usefulness and format of the statement of cash flows. Prepare a statement of cash flows. Contrast the direct and indirect methods of calculating net cash flows from operating activities. Discuss the special problems in preparing a statement of cash flows. And explain the use of a worksheet in preparing a statement of cash flows. The primary purpose of the statement of cash flows is to provide information about a company's receipts and the cash payments during a given period. The secondary objective is to provide cash basis information about the company's operating, investing, and their financing activities. The information in a statement of cash flows should help investors and creditors, our two primary audiences of the financial statements, and others to assess the entity's ability to generate future cash flows, the entity's ability to pay dividends and meet obligations, the reasons for difference between net income and net cash flows from operating activities, and the cash and non-cash investing and financing transactions during the period. The required presentation of the statement of cash flows provides financial statement users with information about the major sources and uses of cash during the fiscal period. The classification of those cash flows. The statement of cash flows classifies cash receipts and cash payments by operating activities, investing activities, and financing activities. Operating activities include all transactions and events that are not investing and financing activities. Operating activities include the cash effects of transactions that enter into the determination of net income, such as cash receipts from sales of goods and services and cash payments to suppliers and employees for acquisitions of inventory and expenses. Operating activities include income determination items. Investing activities include the making and collecting of loans and the acquiring and disposing of investments in productive long-lived assets. Investing activities involve cash flows generally resulting from changes in long-term asset items. Financing activities involve liability and stockholder equity items and include obtaining cash from creditors and repaying the amounts borrowed, and obtaining capital from owners and providing them with a return on and return of their investment. Financing activities involve cash flows generally resulting from changes in long-term liability and stockholders' equity items. Here we have the typical cash receipts and cash payments, how we look at it from an operating perspective. So you have your income statement items, such as sales of goods and services, the returns on loans or on equity securities, as inflows, and then outflows to suppliers for inventory, to employees for services, to governments for taxes, to lenders for interest, to others for expenses. With investing, this is typically going to be long-term assets. That's what you're going to look at. And you're going to look at how cash comes in from things like the sales of the plant, property, and equipment, your debt or equity securities in other entities, your collection principal on loans to other entities, and any cash outflows to purchase properties, plants, and equipment, to purchase debt or equity securities, or to make loans to other entities. And finally, the financing activities. And that's going to be your long-term liabilities and your equity items, such as the sale of equity securities, the issuance of debt, stockholder dividends, and the redemption of long-term debt or the reacquisition of capital stock. Some cash flows relating to investing or financing activities are classified as operating activities, such as the receipt of investment income, like the interest and dividends that you see here. And payments of interest to lenders are classified as operating activities. Conversely, some cash flows relating to operating activities are classified as investing or financing activities. So, for example, cash received from the sale of property, plants, and equipment at a gain, although reported in the income statement, is classified as an investing activity, and the effect of the related gain is not included in the net cash flow from operating activities. Likewise, a gain or a loss on the payment of debt is generally part of the cash outflow related to the repayment of the principal amount borrowed, and therefore is a financing activity. So while it seems relatively self-explanatory of cash is cash, it can get a little bit complicated unless you take a step back and really just work through it from top to bottom. The basis recommended by FASB for the statement of cash flows is actually cash and cash equivalents. Cash equivalents, as you will recall, are those short-term, highly liquid investments that are both readily convertible to known amounts of cash, and they're so near their maturity that they present an insignificant risk of changes in interest rates. Generally, that's going to be maturities with 3 months or less to qualify under this definition. You can watch the cash flows of an organization and actually see where they stand in the product life cycle. When a company is in the early stages of their life, they rely heavily on financing. That is the issuance of capital stock or long-term debt in order to acquire the funds to operate and invest in. And then as it goes through time, you notice that it starts to switch and there is less cash inflows from financing and more cash inflows from investing and operating. The information used to prepare the statement of cash flows generally comes from a couple of sources. And there is a format for the statement of cash flows. It runs in the 3 different classifications. It starts with operating activities, goes to investing activities, and ends in financing activities. The difference between the direct and indirect method is only evidenced in how we arrive at cash flows from operating activities. Reports of inflows and outflows from investing and financing activities are done separately, and they're done the same way under either method. Here we have a basic statement of cash flows, just to give you an idea of what it looks like. And now we're going to talk about the actual preparation of the statement of cash flows. Information used to prepare the statement of cash flows generally comes from these 3 major sources, being the comparative balance sheets, the current income statement, and some selected transaction data. Actual preparation of the statement of cash flows involves 3 steps. Determine the change in cash. The difference between the beginning and the ending balance can be easily computed by taking a look at the comparative balance sheets. Determine the net cash flow from operating activities. This procedure involves analyzing not only the current year's income statement, but also the comparative balance sheet as well as selected transaction data. and then determine the net cash flows from investing and financing activities. All other changes in the balance sheet accounts have to be analyzed to determine their effects on cash. To compute net cash flows from operating activities, it's necessary to report revenues and expenses on a cash basis. This is done by eliminating the effects of income statement transactions that did not result in a corresponding increase or decrease in cash. The conversion of accrual-based net income to net cash flow from operating activities can be done via either the direct method or the indirect method. So here we're going to begin by looking at Tax Consultants Incorporated, who started on January 1st, 2016, when they issued 60,000 shares of $1 par value common stock for $60,000 in cash. The company rented its office space, furniture, and equipment and performed tax consulting services throughout the first year. The comparative balance sheet at the beginning and the end of the year 2016 are going to appear in illustration 23.3. Illustration 23.4 is going to show the income statement and the additional information for tax consultants. So it'd probably behoove you to open your books to these pages so that way you can follow along as we go through this. We begin with the comparative balance statement and we calculate what the changes in the comparative balance statement are. Was there an increase or a decrease in each of these accounts from the beginning to the end? You see where we have the change representing the increases and decreases there in the right-hand column. Examination of the data indicates that there was a dividend of $14,000 that was declared and paid during the year. This is our selected transaction data. One way that you can see that is that there's net income of $34,000. That net income of $34,000 when closed out to retained earnings would leave an amount in retained earnings of $34,000. As there is only a balance of $20,000 in retained earnings, this is evidence of a $14,000 dividend that was declared and paid. So we're going to follow this step by step. What was the change in cash? There's a $49,000 increase in the cash. In this particular one, we don't have to worry about cash equivalents. We don't have any. Step 2 is what is our net cash flow from operating activities? We need to determine what revenues and expenses are on a cash basis and eliminate the effects of the income statement transactions that don't result in an increase or a decrease in cash, and convert the net income to the net cash flow from operating activities using either the direct method or the indirect method. Here is a basic diagram showing you how to determine the net cash flows from operating activities. Remember, revenues and expenses are based off an accrual basis. We need to eliminate those things that did not convert to cash in the current period. So we take a look at, and we're using the indirect method. We take a look at all of the assets. A few notes on the indirect method is that FASB actually encourages the use of the direct method, but the indirect method is allowed. However, if the direct method is used, FASB requires that a reconciliation of net income to net cash flow from operations be provided in a separate schedule. Therefore, regardless of which method, the indirect reconciliation approach has to be presented. We begin by looking at the current assets. When non-cash current assets increase and non-cash current liability accounts decrease, the change is subtracted from net income. So when the accounts receivable balance increased, cash receipts are lower than the revenue earned under the accrual basis. We had $89,000 in actual receipts from customers. We've yet to actually receive $36,000 of the cash. We'll receive that at a later period of time. So we start with net income, and then we go into our adjustments to reconcile net income to net cash. We reduce by our increase in accounts receivable. The increase in accounts receivable is subtracted to arrive at net cash provided by operating activities. Now we go and we continue through and we go to the next account in line, which was accounts payable. And that we're, like I said, we're looking at current assets and current liabilities only. When non-cash current asset accounts decrease or non-cash current liability accounts increase, the change is subtracted from net income. When non-cash current assets increase and non-cash current liability accounts increase, the amount is subtracted from net income. My apologies. So when they increase, we add it to net income. When accounts payables increased during the year, expenses on the accrual basis exceeded those on the cash basis. Next, we need to determine our net cash flows from investing and financing activities. We've looked at everything that was current. We had accounts payable, we had cash, we had accounts receivable. We recognize that there was an issuance of common stock in the amount of $60,000. That was the change. And we didn't have any investing activities for this organization because we didn't have any change in our long-term assets. We have retained earnings of $20,000. But that retained earnings actually ties back to net income, right? Net income adjusted to cash provided net cash from operating activities of $3,000. We had the issuance of common stock in the form of $60,000 cash inflows and a payment of cash dividends of $14,000. Therefore, our financing activities resulted in a net cash provided by financing activities of $46,000 and a net increase in cash of $49,000. We post what cash was on January 1st, what cash was on December 31st, and that tells us what the change should have been. We true that to what our net increase in cash is, and we can tell if we have accounted for all things. Here we have the finished illustration of the statement of cash flows for 2016 for Tax Consultants Incorporated. Here we have a little bit more of a complicated company. It's Norman Company, and their financial statements for the year ending December 31st, 2017 have all of this information. They show us 2017, they show us 2016, and what the appropriate changes are for accounts receivable, accounts payable, and income taxes payable, as well as the income statement data for 2017. We begin by preparing the operating activities section of the statement of cash flows using the indirect method. That starts with net income. And then we go through the adjustments to reconcile net income to the net cash provided by operating activities. Depreciation is not a cash expense. It is a cost allocation, that cash outlay occurred at a different period. This is only an allocation. So we need to back that out of its impact to net income. So an expense would reduce net income. Therefore, we add it back in the amount of $60,000. There was a loss on a sale of equipment. So a loss does not actually represent the amount of cash that was received or given up. It represents the difference between the amount of consideration received and the book value. It is also not an operating activity because it's on equipment, which is a long-term asset. So we need to remove the effect of the loss on the sale of equipment and add it back to net income. The decrease in accounts receivable indicates that there was $22,000 that we collected from a prior period. So we received not only all of our net income amounts in cash, all of our revenues amounts in cash, but an additional $22,000. We had an increase in accounts payable, which means that there's $15,000 worth of expenses that we have actually yet to pay for. So we add them back to our net income to come to a cash basis. And there was a decrease in the income taxes payable. So we will reduce that from our income tax expense from our net income in reconciling what actually happened in cash. Therefore, total cash that was provided by operating activities is $208,500. Their financial statements for the year ended December 31st, 2017 had all of this information. And we're assuming that accounts payable related to operating expenses, because it typically does. So we started with a balance of $59,000 in accounts receivable. Underneath the direct method, we would show cash receipts from customers is equal to sales revenue plus a decrease in accounts revenue or minus an increase in accounts receivable, not accounts revenue. So total receipts from customers is $862,000. We then look at what our cash payments for operating expenses are. And that is we add increases in prepaid expenses or decrease for decreases in prepaid expenses. And we add for decreases in accrued expenses payable, or we decrease for increases in accrued expenses payable. Giving us payments for operating expenses of $609,000. An income tax payable of $44,500. So using the direct method, we would show total cash receipts from customers of $862,000, cash paid for operating expenses of $609,000, and cash paid for income taxes of $44,500. Then we would have the same amount of cash provided by operating activities of $208,500. So there we actually did both the direct method and the indirect method. Steps 3 ask us to determine our net cash flow from investing and financing activities, and this is the same under either method. There are plant assets that had a cost of $25,000 6 years before and were being depreciated on a straight line basis over 10 years with no estimated scrap value that were sold for $5,300. We take that $25,000 and divide it by 10, and then we multiply that by 6 to determine how much accumulated depreciation is on the books currently. With plant asset costs of $25,000, accumulated depreciation at 15, there's book value of 10. We received $5,300, so that means that we incurred a loss of $4,700. So the adjustment, we're going back again to the indirect method. We add it back in operating. And then we recognize how much cash was actually received on the sale of plant assets. And that was $5,300. During the year, there were 10,000 shares of common stock with a stated value of $10 a share that were issued for $33 per share. Is that an investing activity or a financing activity? That's a financing activity. We sold $330,000 worth of common stock. The company sustained a net loss for the year of $50,000. Depreciation amounted to $22,000, and a gain of $9,000 was realized on the sale of land for $39,000 worth of cash. We have the net loss. We have the add back of the depreciation expense. And then we have the adjustment to remove the effect of the gain on net income. We then recognize the sale of the land at what the transaction actually was. During the year, treasury stock costing $47,000 was purchased. So the repurchase of treasury stock is a cash outflow in the amount of $47,000 related to financing activities. Total net change in cash is a positive $295,000. $283,000 of which is from financing activities. $44,300 was provided by investing activities, and there was a consumption of cash or a use of cash at $32,300 for operations. The sources of information for the statement of cash flows can be found on the comparative balance sheet, looking at the retained earnings account, and includes all changes that have passed through cash or have resulted in an increase or a decrease in cash. Write-downs, amortizations, and book entries such as depreciation have no effect on cash. So when we start with a net income, we need to undo their effects. This is a great slide to have handy for the indirect method and to know what you do. Whether you add it to net income or you reduce it from net income.